What is coming up and can be expected from the budget and the big reserve policy meeting as well in March? DK Joshi is principal economist at Crisil, now joins us. Mr. Joshi, I want to first get your reaction on all the news that we have been collecting over the week. It's been a very heavy data week, in fact. IIP showing a big drop when it was not expected, inflation easing more than expected. What's the end game here? Another rate cut?
Well, yeah, I think with the inflation coming down so sharply, and I think the RBI's expectations on inflation, I think this number will be much lower than the year will end with a lower inflation rate than what RBI is expecting. So I think from an inflation perspective also, the monetary policy will be supportive. But I think more important is what you said earlier. I think the growth, I mean IIP, GDP, I think all that is very clearly pointing out that economy is way below the potential, and I think now needs to be supported by monetary policy also. So it's not that inflation war is over. I mean, inflation is still quite high. Even the WPI inflation, which came down yesterday to 6.6, is way above RBI's comfort zone. But I think now the trajectory is becoming clearer that I think there's going ahead. But I think worry on the inflation again is from the CPI side. I mean, the consumer prices to rule high, and I think that that is what will also play out in the mind of RBI. But I think we expect that even on March policy, the central bank will cut rates.
But Mr. Joshi, does it not bother you at this point, the divergence that you're seeing between the CPI and the WPI? And the CPI is something that Dr. Subbarao did allude to, but it's something that they don't have particularly too much control over. But that rising for 4 straight months is also going to exude pressure onto the economy.
Yeah, it will. I mean, I think if I take you back to the Lehman crisis period, I mean, the WPI inflation had come down to negative, and the core inflation was almost to zero. But CPI inflation was still 12.5%. So there are periods of extreme divergence. And here today, I think the divergence is mainly because of the food. I mean, food has lower weight in WPI, so that is why high food inflation is not getting reflected here, whereas manufactured items have a very large weight in WPI and their prices have been depressed, so that is pulling the WPI inflation down. So I think that's the cause, and they don't always move in tandem, I mean, because the composition is quite different. So I think that reflects in the behavior of both CPI and WPI inflation. And I think currently, as I said, the food inflation is the main cause of divergence.
I want to get back to growth, and this is what worries me. A lot of people pushing for that rate cut and putting the onus back to Mint Street when it comes to revival of growth. But here's the concern. If manufacturing is slowed down to a 19-year low, you've seen the core output data as well, and you've also highlighted the fact that natural gas, coal, fertilizer is contracting, and quite significantly so. These aren't sectors that a rate cut can do anything for. It's mostly more on the structural side, on the policy side. So it doesn't really give that push for a pedal for a further rate cut. It's more so sentimental, won't you say, Mr. Joshi?
No, I think it will operate at the margin. See, a rate cut cannot turn around the manufacturing story. I entirely agree with that. The manufacturing sector is getting impacted by mining. Mining has been extremely low. I think there had been hardly any growth in the last 2 years, and obviously that gets reflected in electricity, it gets reflected in the manufacturing sector. So the supply side bottlenecks are clearly holding the industrial activity down, and that these aspects cannot be corrected through monetary policy. Where monetary policy will have some impact is, I think it will ease constraints in some of the highly leveraged, for some of the highly leveraged infrastructure players. Some constraint it will ease. And I think what it will also do is it will give a gentle push to consumption demand. I think the housing loans and the other loans will become slightly cheaper. So it will operate at the margin. It will help push the consumption demand in the economy. And what we expect in 2013-14 is 6.4% growth, and that is entirely driven. I think investments, we don't expect a major lift, because for investments to improve, the investment climate has to improve significantly. For that, whatever actions government has been taking over the last 6 months or so, I think the momentum on them needs to be maintained. Only then you will see investment pipeline replenish, and only when that replenishes you will see investment activity go up. So I think it's immediately, if you want to give a push to growth, I think the first thing to do is to sort out the issues in the natural resource sector, which is mining. And I think if you do that, I think that gives an increment to manufacturing. I think then come the other things like which will push investment activity up. These are steps like land acquisition bill getting cleared, taking quick decisions from the government side. If you do that, I think then you create a platform in which the growth will move up and will be sustained at a higher levels. Without that, I think just by tweaking interest rates, though the problems that I just talked about, they cannot be addressed through interest rates. It will only operate at the margin at this juncture.
Mr. Joshi, lastly, the big bang, all eyes on the deficit picture. I know a lot of people are putting the focus on a fiscal deficit, but I think the markets now are pricing in the fact that he's going to make it. It's really about pride now at this point, whether he's going to make that 5.3 to 5.1% mark. But the real worry coming from the current account deficit as well, from the economy side of it, how big a worry is that ballooning trade deficit number, $20 billion, as well as the shrinking import cover that you've seen over the last few months. 7-month import cover is not something India can be comfortable with, not being a country that can go ahead and just print currency to improve that situation.
Well, I agree. I mean, see, the high current account deficit increases the volatility of the economy. So if there is any capital outflow for any reason, I think the rupee will take a beating under that scenario. But the good news is that the tail risks in the advanced economies have reduced quite a bit. I think after positive actions from the European Central Bank since September last year, the US is expected to do better this year. And also I think the other economies like Japan, they are getting into excessive so-called monetization, or too much of liquidity they'll pump into the system. I think that scenario, where there is no tail risk, the reason for a capital outflow emerging from outside India, I think the probability of that materializing, I think is low. So my sense is our current account deficit will get financed in this scenario. But yeah, we remain vulnerable, because if for some reason the inflow doesn't come in, then I think we have a big trouble, not only for the rupee, but also for people who have borrowed abroad and so on and so forth. So I think we need to bring the current account deficit down. As far as the budget is concerned, I think it's a very tough task ahead, because I think making budget in a slowing economy is a very big challenge, because you don't have a revenue kick, and you need to keep the expenditures going, because you also need to promote growth. I mean, so I think how balance the need to push growth up with the with the need for fiscal consolidation is, I think, what I'll watch out for. And I think what I'll also look for is how strong is the fiscal arithmetic behind it. I mean, are the numbers premised on sound assumptions or not? I think so. Budget would be it would be very interesting to watch from this aspect. I don't expect the budget to be very expansionary in nature, because Finance Minister has already, even before the budget, he has specified the fiscal deficit targets, and his commitment to reducing fiscal deficit over a period of time. So I think now the focus should shift on the quality of expenditure, not merely on the quantity of expenditure, because a lot can be done through the budget as far as the quality of expenditure is also concerned. So right. Increasing the quantity of expenditure is going to be difficult at this juncture.
All right, Mr. Joshi, thanks for joining in. That's the economy view coming in. A lot of concerns still remain ahead of that big budget. Will he make that deficit target? And more importantly, the current account deficit and the vulnerability that India right now faces from those strong inflows. But the other point Mr. Joshi was making, a assumption that is getting hit, and that's what we put the focus on right after this short break. We put the spotlight on